Hi guys, welcome. This is a little bit of a one-off. We did this exact presentation yesterday for the Money Show, and apparently there was an internet problem, a little bit of an audio problem. So what Julie and I have done is we're back, and we are doing this again, sort of going into the market close on Friday with a group of our students who wanted to sign up for the same thing. Same presentation. Going to go over exactly the same stuff for all of you, so you didn't miss anything yesterday if you didn't catch the audio exactly right. But with that said, I just want to say welcome and sort of give you a run through on what it is that we're planning on doing today. So first and foremost, this is about trading intraday, about trading for income. And when you're trading for income, it's a little bit different than when you're trading to build wealth. This course is very suitably titled, right? Up, down, sideways. How are you going to build a profitable trading business, something that can make money in any market? And I want to get into that today. So essentially, over the course of the next couple hours, we're going to take some time and we're going to do a deep dive into what it is that Julie and I have done since 1997, how it is that we've earned our keep trading the markets, and what it is that goes into designing the strategies that we use every day. Before we get to that part of the presentation, we're going to look at something that is as important, if not more important, than strategy, and that's psychology. And it tends to be the case that if we put the psychology portion of these things at the back end of a show, then what people do is they leave after the strategies, right? Everybody wants the strategies. Everybody wants to know, what are you doing to make money in the markets? And the reality is the only way the strategy is going to work for you live in the market is if it's suitable for your psychology as a trader. So when we get into the part of this that Julie's doing, which is right at the beginning, she's going to cover the psychology of trading. You're going to get a look at the things that we think are important in terms of, how do you structure your trading business? How do you structure your trades? How do you structure your morning, your trading day in a way that's going to make it easy for you to profit from, in terms of not getting yourself upset, not getting yourself neurotic, being able to stick to a plan, follow through over the course of the session. And then we're also going to give you access to some tests that we have at Trader Insight. Totally free. You can just take the tests by texting. In one case, you're going to text balance. In another case, you're going to text the word work. And those are just going to give you access to these assessments that we have that go through and try to figure out how much, let's say, conscientiousness, neuroticism, and risk aversion or risk acceptance factor into who you are as a person. That's one of the tests. The second one is going to be about what kind of a work environment, what kind of workflow is optimal for you as you're trying to build a trading business, because that's very important. You're not looking to pound the square peg into the round hole. You're looking to try and get as good a fit as you possibly can between how it is that you probably see yourself as a trader or working in whatever it is that you do, and what each part of the day in trading actually looks like. And you'll get then the raw score data back immediately, and you'll get the interpretation scores back immediately, and then you can also watch some videos for free that will explain to you what it is that we think the impact of each of those measures has on you. And then Julie's going to go through just a very quick thing with you, which is an inventory that'll allow you to assess right here, right now, whether or not you have a growth mindset. Growth mindset's very important. You've heard that term thrown around. It's, we're both psychologists, and I think that, nothing is more important than you understanding that it's possible for you to learn new things and it's possible for you to grow as a person, grow as a trader. So that's just a fun little test. So for that, please have a notepad on your desk and just set up 2 columns and number the lines on the page. I think it's 1 through 8. So you want to go 1 through 8, and then you want to have 1 column for disagree and 1 column for agree. And then between those two things, you're going to figure out sort of where you are right this second in terms of having a growth mindset. So with that, let me dig right into today's presentation and start by telling you about us. So for those of you who don't know us, that's Julie and me. We are down on the floor of the New York Stock Exchange there. As I said before, we're both PhDs. We both have doctorates in psychology, MBA in my case, also Masters in Public Policy in Julie's case as well. And while we were in graduate school, this is back in the 1990s, we decided to start looking at market data. And market data, you know, it's very important as a grad student that you have stuff that you can analyze, stuff that you can publish on. And we started finding some very interesting patterns in the market, things that would give you edge. Started working with a specialist firm called Vandermullen, got very close with a fellow down on the floor of the exchange at Doyle Securities, so a $2 broker. Got to know a bunch of the specialists down there and really got an inside look at how things work and the kinds of things that determine whether a trade is going to be high probability or not. And in the case of, you know, where we started, it was all NYSE. We didn't trade NASDAQ. NASDAQ was a little bit too high flying back then. It was much more along the lines of what penny stocks are today, right? Where things were just crazy and you didn't know what to expect and it felt like unregulation and the wild, wild west and all that stuff. But what we did with all that data was largely took it and published a bunch of things. So, you know, I got into, you know, writing articles for Traders Magazine in Germany and, you know, for Active Trader, Stocks and Commodities, you know, all these great magazines that were around that, you know, we sort of cut our teeth on back then. They were very almost academic back then. They weren't such pop magazines as they are now. And then, you know, down in the bottom there, you can see a fellow did a book in which, you know, I was included as, it was called Breakthrough Strategies of Wall Street Traders. That was an interesting one as well because, you know, he did an interview with us or with me at that time to see how things work and why things are working for us. But all along, you know, when we were in grad school, the reason you go get a PhD is eventually you want to teach. You know, the folks at the Money Show and the Traders Expo, that's sort of become our surrogate for going off and teaching at some university somewhere after we were done, because a lot of this stuff is not really the kind of thing that they teach at a university. So when you look at the books that I've written, Around the Horn, A Trader's Guide to Consistently Scoring in the Markets, that is the meat of it. That's where it all started. That's where I developed the patterns that were based on big statistical models and represent sort of everything that it is that we still do today. That's still the lion's share of all the trading that we do today. Trade Secrets, that was a breakout book from Around the Horn that takes one of the setups, a fastball expansion of range and volume, and develops it across multiple time frames. And so fastball, right, what is it? It's a metaphor. The reason I'm using metaphors there, I've said this at a bunch of Traders Expos over the years, is when I presented Around the Horn to my publisher, after having worked on it in grad school, it was titled A Multivariate Analysis of Covariance in the United States Equities Markets. And famously, George said, "Adrian, how many copies of this do you think your mother's going to buy? Because that's a mouthful, and it's not the kind of thing people are typically going to want to read." So we retitled it Around the Horn. It's written around an analogy to baseball. Baseball's a very good fit, in part because of the psychology behind it. Tricks of the Trade there, that was a trade log that we did. And then the international versions of all my books are off on the right there. World Cup Trading, that's the Italian version, and then Trade Secrets and Beat the Street. Those are worldwide publication by Harriman House in London. So, with all that said, right, what's the magic that's kept this stuff alive over the years? I'm going to say the strategies are simple enough that all these guys you see at the table here are able to wrap their psychology around this stuff and become better traders and go out there and actually earn their keep in the market each and every day. That's our income trading boot camp. You know, many of you know about this already. This one was 2019, so we do them in May and November. Of course, in 2020, we ran into COVID-19, so no big groups like this, but these are 20 people at each one of these events who come together to learn what it is that we do. They go through a 700-page workbook before they come. They go through 30 hours of online training before they come. And then when they're there, we do 4 days together of just drilling down and figuring out how to make this stuff fit for people. We've got engineers, we've got attorneys there. We've got a guy who owned a chemical company. I'm just looking around the room there. We've got a guy who's a property manager. We've got a fellow who was a researcher at a pharmaceutical company. And it goes on and on. Every one of those people is going to have a different psychology, and you can't underestimate what it takes to wrap your psychology around trading in a way that's going to make it possible for you to profit. So with that said, let me take a look at the agenda real quick for today. And essentially this is wrapped up in 3 parts. First part is going to be the psychology. Julie's going to get into that in a second here. That is going to represent a very important dynamic in how it is that you interact with the rest of the stuff that I do. Part 2 and part 3, those are strategy sessions. 2 is a strategy that is, involved in statistics. It looks at opening gaps and mean reversions, and it's a very high probability outcome, 95% confidence interval on that one. And we're also going to go over in part 2 sort of the core trades, the around the horn trades, and how those are different from the other stuff that we're going to be doing. Part 3, that's going to be sort of the exciting trade, right? The isolating volatility and going through and following program trading and just really getting into the meat of what the market is doing first thing in the morning. So with that said, I'm going to hand you over to Julie, and she's going to talk to you about the psychology of trading, and then I'll be back in just a little while with the strategies.
Hi, and welcome to our office. We're happy to have you here. If I were going to ask you what you thought the most important part of trading is, what would you say? Probably strategy. What am I going to trade? Or is it tools? What kind of computer do I have? What kind of broker do I have? And these are all huge decisions in trading, right? So what we learned, Adrian showed you a slide of all our mastermind members, and we've had this great pleasure of speaking with them and working with them closely over the last 10 years. And what we learned both about ourselves 20 years ago and with every new and experienced trader, it's actually psychology. So Adrian told you we were going to front load this, and here we are, we're going to talk about it. But I think it's also important to understand how psychology fits into this trading business. So once I started working with these traders more closely, and they were telling me where their challenges were, I developed an acronym about 4 content areas that I like to describe, and I call them tips. So I have a little Venn diagram here to show you. There is there's 4 areas, but the biggest one is psychology, and the other 3 fit right inside. So if you will, there's technology, information, strategy, and psychology. And while we all want to rush to the strategy, and of course you have to have a strategy, it's very important, obviously, and to have a plan is very important. But think about it, and the only thing you bring to the desk every single day is you. Where you are might change, the computer you're using might change, the broker, the internet connections, all of that. That's all up in the air, and things you need to know. But the only thing you're always with is you, and it controls and affects every other piece of your trading business. So it's really more important than you think, and we thought we were going to be teaching folks to trade technically and with strategies, and found over the years that really we are a lot of times helping them understand their psychology and how to address their challenges and get to know themselves better so that they can become more successful and more competent in what they're doing, more confident in what they're doing. So I want to run through these real quick, these different content areas, so you get an idea of what I'm talking about. Technology, and I have a whole other presentation that we've done on this, and we can do again and show you. But technology really consists, what we're talking about is hardware, software, your brokers, your internet. If you think about it, this is online trading. So we are doing nothing but approaching the markets, with our technology. And as far as hardware goes, we are very passionate that you should use a gaming computer. You can just look up, best gaming computer of whatever year we're in at the time, and upgrade that. A lot of folks would come and try and be trading on a laptop or something that they've had for I don't know, 5 to 7 years, and we'd say, maybe kids are learning from home now. Maybe you want to pass that on to one of them and upgrade yourself to something. Adrian was famous for saying, if you're going to enter a race, a car race, you're not going to take the family sedan. So that's depending on how much you're trading, depending on what type of trading you're doing. I mean, if you're entering a trade once a week and it's a investment or a swing trade, maybe you can be in a sedan. What we do is trade intraday, and it's very important that we have the latest and greatest of all gaming GPU that we can get. So software obviously is a big deal, and broker software, all that stuff, internet, we'll talk about that at some other time. The other content area is information, and here we're talking about, generally how the markets work, specifically how your charts work and what a chart is, and also some other things, like news and other information that we always say stay away from the cable fluff, get down to real business news if you're going to get serious about trading. Strategy, like we said, everybody is always rushing off to strategy, and what we would talk about with that, and we can talk about in questions, is really the psychological fit. It's how we started talking about psychology with our traders, because Adrian has a beautiful suite of intraday trades that account for different kinds of market conditions. But they also have different profiles, and there's different ways of trading those. So some fit for some people and others fit for others. So whatever you're going to trade, make sure that it fits your psychology for the easiest route to success. Obviously a financial fit, and whatever it is they're using, the tactics. But let's talk about psychology. Through research, I've done quite a bit of research recently on what makes people successful in trading, what are the challenges people face, and what do successful traders, what characteristics they have in common. And it turns out these are many of them. A lot of people think, you have to be hard-headed when you trade. Actually, it's much better if you're flexible, and growth mindset we'll talk about in a minute. But if you are able to learn and grow as you go, it's actually a much better way to go. A lot of people, we've been talking about recently, a lot of people think that Darwin has been sort of misrepresented, that survival of the fittest has somehow, for who knows why, become synonymous with survival of the strongest, or the strongest survive. And it really means survival of the most adaptable, and that's super true in trading. So one strategy might work at one time, and if it hasn't got adaptable qualities, you're going to have to adapt and go to a different strategy. What's great about what we do here is Adrian started with a bunch of strategies that already went around the market cycle. So I know he's going to talk to you about that, but that has stood the test of time. Throughout time, we've added other things as electronic trading became more, automated trading became more, and program trading became a bigger and bigger factor in trading. But if you can't adapt, then it's a real problem in trading, because it's going to keep moving around you. The next thing that's going to solve a lot of problems is having a plan to follow. So we've always had a plan to follow. Plan the trade and trade the plan. That was our very first slogan, and we had mugs. His mother has a mug in Ohio to show for it. But it's really been a lifesaver, because in trading there's a lot of factors going on, and there's a lot of things that we as human processors are pre-programmed for that don't have anything to do with trading. You'll hear people talk about fight or flight. You'll hear people talk about different cognitive biases. You remember the most recent thing called recency, for instance. And we know, as two psychologists and as grad students, that we couldn't rely on being real-time inside of trades and rely on what we were going to react to at that time. There's too much that goes through a human mind that is pre-programmed in there. So having a plan, knowing where you're going to get in and knowing where you're going to exit, both either if it's a profit or at a stop loss, has been the hallmark of what we've been doing, and what really Adrian has put out there over these years. So that's good. So have a plan. That'll take care of a lot of problems. And then to be self-aware and focused. I kind of jammed those two together, but self-monitors and all the research that's out there, and all these veteran traders. If you read a lot of, we have nothing but books. Adrian started this whole business by reading everything he could. We're PhDs. We go that way. So we read everything we could, and all the veteran traders, the guys that were pros when this whole thing started, all said the same thing, that you have to be focused, but you also have to be a high self-monitor. The people who make the most, that are the most successful, I should say, make the most of their trading, all can look inside themselves and see what's happening and where perhaps they're going wrong. They're monitoring what they're doing. And they can also focus while all these other things, emotions or knee-jerk reactions are going on in the background. You need to stay aware and focused in the front on what you're doing and what's ahead of you, and follow the plan that you've set. Other traders, self-motivated and passionate about trading, there probably is not one successful trader who is not passionate about trading. So if you're entering this with a ho-hum attitude, I would say really sit down and think about what it is you want to do, because it's the ones that are most passionate that are going to spend the time and the energy to learn, because there is a lot to learn when you're starting this business, or if you're going to transition into it. And you have to really want to know that. You have to want to be excited about that. And then it also might surprise you that being positive has a positive relationship with being successful in this business. Adrian was quoting Peter Pan, and he was saying, what is it? You can fly until you believe you can't. Yeah, exactly. So it's something of that nature. But anyway, it's important to believe. And then also self-compassion has to do with patience. So I didn't put patience up there because a lot of times people think self-compassion, that's, what is that, mamsy-pamsy? We got to be rough and tumble and stick to our guns. But actually, self-compassion is really linked to patience. And if you can give yourself some grace, I made a mistake, it's okay, I'll change that, then those are the people that can move on and take the next trade. If you beat yourself up after every trade, it doesn't go so well. All right, so let's talk about psychology. I have this slide up here, this fun slide. It's an old, story, parable, whatever, of blindfolded folks feeling the side of an elephant, if you've never seen an elephant before. And if you're on the side of the elephant, what you've got going on is you feel like you're describing the elephant as a wall, right? If you're up at the ear, it's a fan. If you're feeling the tusk, you're thinking it's a spear. And you're describing the elephant in this way. But psychology itself has about 8 different approaches, and it's very much like this. All of these approaches are really good at describing some part of human behavior. Not one of the approaches describes all of human behavior. So when you're out there and you're talking about psychology, or you're reading coaching books, or thinking about how you're going to sort out any challenges that you may have, it's helpful to know that there's different approaches, and there's a psychological fit for strategy. There's also a psychological fit for psychology. So let's take a look at some of those. So these 7 slices, orange slices or pie wedges, or however we want to say, these represent some of the biggest of the approaches and disciplines in psychology. So humanistic is, we should really start with psychodynamic. That's what most people know. That's sort of your Freud and Jung, and that's what does your childhood have to bear, your upbringing have to bear on what you're thinking about trading. Behavioral, that would be very much more, like I pull the trigger when I do this, so there's more of a, snap a rubber band and stop that behavior. More of a Pavlov type of thing. Cognitive, behavioral together, cognitive is all about the biases you have as you go through. And I'm a social psychologist, there are a million cognitive biases we all have in order to get through our day. I mean, we evolved with these things, these shortcuts really, so that we can not have to evaluate everything at all times. Biological, this has to do with the way we're wired or hardwired, and cultural has to do with things, sometimes, Adrian will talk about too, that in the U.S. we're taught to win, so sometimes it's very hard for traders to cut their losses because culturally we want to win, and then there's other cultures that might feel differently about things. So anyway, there's all these different slices that go on. And humanistic is the one that would be approaching through a more mindfulness and thinking about getting self-actualized and getting to your best you. these are all things that can be helpful. Cognitive behavioral together are usually very, very powerful and things that you can do for yourself. These other ones you might want to go and have, or you'd be talking to somebody else about some of these things. But we've done things such as I've suggested to people, if we define success as following your plan, as I've mentioned. So we've suggested having a bowl of marbles and two different jars, and one you put a marble in every time you followed your plan that day, and the other one you put it in the other one when you didn't follow your plan, you cut your losses, or you didn't let your profit run, or you didn't pull the trigger when you should have to get into a trade. And then you can have a very visual representation of what went on that day, right? I also suggested to someone else, there's a couple different, like I said, a couple different approaches we have in our trading room, a couple different styles of trades. And I said, well, maybe it would be helpful to have a couple baseball hats in front of you, and you could put on one that when you're in one kind of trade, and actually take it off and put it on another one when you're in another trade. And I actually have gotten some feedback that these things are helpful because they're things that you show yourself what you're doing. So that's fun. The best and most interesting thing for any psychologist in recent years has been the next slide here, which is neuroplasticity, and they've found how neurons can grow and change for the rest of your life, well into adulthood. There used to be an idea that these things didn't happen, they didn't grow, you were stuck at a certain age with what you had. And they've learned that's not true. You can learn throughout your entire life. And the idea of a growth mindset is adding yet at the end, right? So I don't know how to play piano yet. I don't know how to trade intraday yet. And just to have this idea that it's knowable, it's learnable. And the scientific studies that are out there, and there's a lot of them because people are pretty excited about this because it is exciting, show that with experience and practice, this just doesn't happen if you sit around, but if you focus, the neurons that go to one way of thinking, the more you practice it going to another way of thinking, the stronger those bonds become, the faster those bonds become, and they can actually change. So you can learn your entire life. So in trading, this is good news. Since I've already told you we need to adapt to the market conditions every time they're happening, it's a really good idea to take this in and believe, okay, I can learn something new, I can do something new. But let's see if you do believe that. So I have a quick 8 questions for you to go through. We're going to go through those together. So as Adrian said, it's just 1 through 8 on a piece of paper, and you're just going to agree or disagree. So here we go. Okay, so the first one, no matter how much intelligence you have, you can always change it a good deal. So do you agree or disagree that no matter how much intelligence you have, you can always change it a good deal? Just off the top of your head, do you agree? Do you not agree? No one else is going to see this. This is for you. Number 2, you can learn new things, but you cannot really change your basic level of intelligence. So do you think, just off the top of your head, you can learn new things, but you cannot really change your basic level of intelligence? Agree or disagree? Number 3, I like my work best when it makes me think hard. I like my work best when it makes me think hard. Agree or disagree? Number 4, I like my work best when I can do it really well without too much trouble. I like it best when I can do it really well without too much trouble. Agree or disagree? Number 5, I like work that I'll learn from even if I make a lot of mistakes. Agree or disagree? I like work I'll learn from even if I make a lot of mistakes. 6, I like my work best when I can do it perfectly without any mistakes. Agree or disagree? Perfectly without any mistakes. Number 7, when something is hard, it just makes me want to work more on it, not less. Agree or disagree? If it's hard, you want to work more, not less. And number 8, to tell the truth, when I work hard, it makes me feel as though I'm not very smart. Agree or disagree? Okay, so now what you're going to do is you're going to just add up all the agrees on the evens and all the agrees on the odds. All right, so it turns out the odds have it. If you had more agrees on the odds, then you're on a good way to a growth mindset. You understand you can increase your intelligence, you're not afraid of a challenge, working hard is best, and you can make mistakes along the way. Having a growth mindset really helps you because you realize I'm going to make mistakes. And even if I didn't make a mistake and I did this purposefully, you took a stop loss when you should, well, that's where the marble goes in the right jar. You did what you were supposed to do, and that's a part of this business. So, I don't know, do you have any of these challenges? Most everyone I talk to about trading, that's the fun part about being at a conference is you get to talk to a lot of people. And I think almost everyone who's traded, including ourselves, have experienced at least some of these challenges. To cut winning trades short, to fail to pull the trigger on good setups, let our losers run, add to losing positions, and hope. Some of our traders, we have this next one, you have profits in the morning profits and afternoon losses. We have traders that will just participate in the room in the morning, and when they are done with their trading, they actually physically leave because they have told us that they'll sit there and trade all day and lose it again. They're profitable in the morning, and in the afternoon they give it back. So that's an easy one to solve, right? Get out, play some golf. Take a walk. Take unplanned trades. I'm guilty of that sometimes. Hold trades for the home run and reduce position size after a loss. These are all things that can be addressed. These are all things where you can get better. You can have a challenge that you feel as if you can't overcome. They can all be overcome. So it's all just a matter of what your challenge is and which way you're going to address it. One of the things that we like to do with our traders is we have a variety of these psychological self-assessments. So the answers come back to you. And then you get to learn a little bit about yourself and how you react to things. Sometimes it's surprising, So this first assessment is great. It measures your ability to follow through on your trading plan, also your tendency to either blame yourself for negative outcomes and be very upset about that, and also your relationship with risk. So it gives you a good idea of how hard you are on yourself and how much balance you have within yourself, and then no matter what the outcome is, there's no right or wrong answer. There's never going to be an assessment that says, oh, you can't trade. There's just going to be assessments that say, here's the areas you're going to want to address, right? So that's fun. And if you want to do that, then you just text balance, the word balance, to this number here. So it's 310-299-9148. And it's an autoresponder that it's just going to put you right in and email out the assessment to you. And you can do that at your leisure, and it'll come back and give you the results. And then if you're interested in finding out, sort of where you compare with other traders, we are also going to have a section discussing that as well. So you'll get all of that. So that's one assessment. And then the next assessment is a work environment scale. And this is really interesting and important. One of the things that I usually talk about when I'm saying people are looking to go into trading, new traders, and one of the things I have them do is the 3 W's and an H, who, what, where, why. And the work environment has to do with where. And are you at home? Are you by yourself? Do you like that? Do you like to be with other people? How do you like your workflow to go? And these, again, they're things you might find out about. It's always interesting to find out a little bit more about how it is that you like to or would like to work. And if it has to do with not wanting to be alone, come join us in our room. We have alumni that are in our trading room. It's really a training room for our new folks that were coming in, but it's turned out to be this really wonderful place where our alumni love to come because it's a great place to have some community within trading. It can be a lonely business, and this has been a lot of fun for us, and it's a lot of fun for other people too. But anyway, so if you would want to take that one, you text work to the word work to same number, 310-299-9148. And again, it's an autoresponder, so it'll just send you out that inventory, and then you can take a look at that as well.
So Julie always does a great job of talking about the psychology. And it's interesting because we're both psychologists, and I think over the course of 20 years or 23 years or whatever it's been now that I've been doing these shows, people sort of like to come to me for the strategy side of this thing, and that's okay. I mean, but I value the psychology every bit as much as she does, and we've both seen it. So we've seen lots and lots of people, really do well with this. They'll walk out of that boot camp. We've got people who will, at the boot camp, earn back the tuition of the boot camp over the course of 3 days, no problem. We've got other people who take 6 months to become profitable traders, and then we've got people who will take a year before they're out there and really able to do what it is that they wanted to do. And the guys who are out a year, it's very consistent that it's sort of 8-9 months into it that they'll tell us, well, I think part of my problem is all my life I've suffered from attention deficit disorder. And we'll say, oh my God, you should have led with that. This is what we should have started with so that we could help you, figure out ways. Is it moving the marbles from one jar to the other? I mean, because that's not a kid's game. That's a grown-up game. That's something you do with adults to say, here's how you overcome this thing that's holding you back. And that's fine. But whether it was the guy who takes a little bit longer because he's a little bit ADD, or the guy who comes and he manages to just dive in, find one strategy, because that's the psychology right there, right? Is we've got people who come to the boot camps, somebody will find one strategy that resonates with them, and then even though they've learned all the other stuff, they don't do it. Because this is what their psychology is about, is I want to find something that works for me, and once I have something that resonates, that's the thing that I'm going to do, and I'm just going to keep doing it. So we've got our friend Bibbs, who, many of you in the first hour trading pit, know him. He came to boot camp a year and a half ago. He left boot camp, immediately started earning, $1,000 a day at least trading Apple, and he retired from his law practice. That was his goal when he came to the boot camp, was I want to figure out what I can do to replace income from my law practice by doing something else. I've been practicing law for 20 years. I'm going to find the thing that's going to work for me, and I'm going to glom onto it. Goran, who many of you know, engineer, right? The engineers have a totally different psychology. They have to go through and re-engineer everything. They need to make sure that there are not inefficiencies that are lost in the model. And he's got so many spreadsheets for everything that, you would think he would never get to the point that he was satisfied with something, but he did. Very shortly after the boot camp, profitable trader. And I can go right down the list until I get to a fellow named Johnny. And Johnny is someone you see in the room. Johnny's one of my very close friends from childhood. I didn't see the guy for the better part of 30 years. So he shows up on my doorstep when we're just about 50 years old at the time, I guess. And he says, I sort of been following what you do, and that's what I want to do right there. I want to learn how to do this. So I'm buying your boot camp, I'm going to come to this thing. And I said, well, wait a second, right? 600 people apply for boot camp every year. We accept 40, right? 20 to each boot camp. I don't know that, this might not be a good fit for you. And essentially when you meet him, you're going to see he's a very charismatic guy, and he managed to talk us into this was right for him. He never told us that the prior year he had left something like $90,000 in Las Vegas because part of his earnings as a human being, right, he was a professional gambler. And that's a very different psychology than the rest of this. So when you're looking at these strategies coming up, don't go in with the notion that as long as it makes money, I can make it fit my psychology. Because I can tell you that he had a very hard time because he liked action. He's doing very well now. This is a year later, right? But when he started, fourth bar of the day, I was doing risk management for him, because he was brand new to trading, so somebody had to take a look at what he was doing. And I'd look at his chart and I'd say, John, you did 400 trades. We're on the 6th bar of the session. How is it possible you did 400 trades? Well, I like the action, right? This is where we started getting into, maybe we didn't vet our old friend as well as we would vet a total stranger. And what it really came down to was just going through and rethinking this whole thing with him and saying, if you take a very pragmatic approach to this, a very scientific approach to this, a very structured approach to this, you're going to be much happier with your results. You're not going to wind up with he always had $1,500 profit in the morning. By noon, he had a $1,500 loss, a total turnaround, and then some, right? It's a $3,000 draw against the profit that he had in the morning, and by the end of the day, he was positive again. Well, what's going on? Well, he had spent his whole life enamored with the idea that he's scrappy and he can dig his way out of a mess. And that was his psychology. So as we go through the strategies, just sort of think about your psychology. These are time-tested strategies. And I've been working on these for many, many years. So since 1997, I've been looking at these things in the terms that you're going to be looking at them today. That's when the Around the Horn stuff started happening. That's when the book was written. Right, we're on our 4th edition of this book. It is currently out of print, so you're not going to be picking this up in a bookstore anytime soon. But it's going to be back probably first thing in the new year. And it's going to have a much heavier reliance on psychology this go around. So you're going to see sort of the classic text, the bestseller, Around the Horn: A Trader's Guide to Consistently Scoring in the Markets, rewritten so that we can go through and address these issues of psychology that I just think are so very important. Now, what is the metaphor, right? So this is the basis of what we do. It's not the lion's share of what we're going to talk about today, but Around the Horn really refers to the fact that we've got markets that are cyclical. So over time, what we can count on is the markets move through very predictable phases. And as these phases play out, we can find opportunities for profit with the patterns in Around the Horn. So in a second here, this is going to mark up for you. You can see on the bottom left here that we have got a box, that's yellow, and that box represents accumulation. And accumulation is something, a lot of people will tell you, well, that's an accumulation range, and I'm going to tell you on the other side of it, you're not going to know it's accumulation until after it happened. But after accumulation, you're either going to get markup or markdown. And in this case, we've got a period of markup. That's the green arrow, followed by another yellow box there, right? We don't know what that is until it finishes, until it breaks out, goes into a distribution range, and the distribution is followed by a markdown. And then, of course, the markdown is followed by another range, which could be accumulation, could be distribution. We don't know until it happens. Inside that thing there, that's where all the Around the Horn patterns play out. So as you look at this, you should see the bottom of each of the yellow boxes is support. The top of each of the yellow boxes is resistance. That's what defines those opportunities from the Around the Horn stuff. You guys who are familiar with it know that we're targeting support or resistance for our profits, and we're using a violation of support and resistance to stop our losses. So here's an example. This is it playing out on a daily chart of just the Dow Industrials. And if you look down here again, right bottom left, you've got accumulation followed by markup, followed by a retracement, followed by another markup, right? Another accumulation range, markup, accumulation, markup. Market was just on a tear here. So each one of those has a support and resistance area. And when you look at the rest of the chart, you can see that price tends to inflect right at those spots. Now, you need to be conscious of the trend. You need to be conscious of where you are, right? If you're above, then that resistance is support. If you're below, that support becomes resistance. It's classic chart reading, and it really plays out in just any type of market, right? Because here's the market this year. And this year you see it happen again, right? The same phenomenon. You see you've got a range up there that initially you probably thought was going to be accumulation, and then it winds up being the case that that support and resistance lead to a big distribution. You've got a markdown, you have a retracement again, and this time the retracement leads to support and resistance in the form of an accumulation range, markup, another accumulation range, support, resistance, right? And it just keeps playing out over time. So that same phenomenon that you looked at in the first slide, repeat performance in this year's trading. And I can't tell you how true that is of just everything that we do. Look at this chart here, and you're looking at all the bar graphs and all the data that represent the Around the Horn trading plan. And you can see now it looks like it's flatlining going into the close of the year. That's because we are not at the close of the year yet, right? That's 2020 year to date. And that data right there represents a very good year. Those are all the patterns. Those are the cycle patterns. They play out over the course of the session, and they are much more like intraday swing trades than they are like day trades. They close out at the end of the day, but those are all NYSE-based trades. The New York Stock Exchange and the NASDAQ, very different animals to this day. Nothing has changed about that. You're still dealing with a specialist-driven market. Now they're called designated market makers, but that market, very, very orderly. And what you see here when you're looking at 2020 is a year where just all the patterns have been profitable over time. There were months that were slow, there were months that were great, but over time, this thing is going out into the end of the year looking really strong, just like it did in 2019. 2019 was a very different year, but look at the numbers, right? Off to the left, you can see the numbers for the year. You can see how the plan performed. That's the straight up around the horn trading plan that I publish every day. I've got all the records for this back to 2006. They're on the site. You're going to get access to this trading plan for at least 2 weeks, 4 weeks if you want it, for free. I'm just going to cap it at 2 weeks this time because I find, sometimes the people who aren't super interested, they'll stop looking at it at 2 weeks and then they stop opening the emails. And if you get the email every day that the plan's ready and you don't open it, we actually get dinged because we're sending out an email that somebody's not interested in. So just bear that in mind. If you want to go the full 4 weeks, you just give us a call and let us know, and we'll get you the full month on the trial. But look at 2019. I mean, it played out over time. The thing about this trading plan, very consistent. Some people tend to find it boring because it's very much about method. It's very much about following through and just doing what you say you're going to do every day, right? What's your measure of success as a trader? It can't be, did I make money today? Did I make money in the last 5 minutes? Did I make money in the last hour, in the last 2 days, last 3 days, last week? It's got to be, am I consistent over time? And the only way to measure consistency over time is to compare yourself to a blotter like this that looks at, here is what would have happened if I would have taken each one of these trades exactly the way that the money management rules say to take them. Because there's no coulda, woulda, shoulda here. This is not about maximum favorable excursion. Each one of the trades is, when you go back and dig through the spreadsheets that make up this summary for the year, what you're going to see is for each month, every single trade is line itemed out. And you'll see, did it hit the trigger price? Did it hit the entry price? Did it make it 50% of the distance to the profit objective? If it made it 50% of the distance to the profit target, your stop gets moved to break even. Did it get 10 cents to the profit target? If it made it 10 cents to the target, your stop moves to the 50% level. Did it hit the profit target? If it did, you're out. There's no maximum that it could have gone here. It's just, did it hit the entry? Did it stop you out? Did it hit the target? Here are the money management rules in between. There's a very objective way for us to train the people we work with, and it's the reason that we use it to this day. So we keep this very up to date, very much up to the second, so that the students, the people we work with who want to be professional traders can go back and look at this and say, here's my metric for success. This is the very disciplined approach to the market, and I need to learn how to do this before I can learn to do a little bit more shooting from the hip, right? Because you start shooting from the hip right out of the gate, I guarantee you what you're going to wind up doing is shooting off a toe. And then finally, let's take a look at something interesting here. This is 2008. Look at 2008. Again, this was a year where we had a bias on the short side. If you look at the chart down on the bottom right there, you can see how many more shorts there were than longs. And I remember, I did an interview with Kathy Gibbs, and that was back in 2007. She said, what are you doing with all these new highs? And I said, we're selling them because the patterns are indicating that we've got lots of opportunity on the short side. And 2008 was actually one of our most profitable years ever. So you can see here, the basic strategy allows us to profit in any market, right? Up, down, sideways. The years that I showed you very much represented the extremes that we've seen. And in each case, that around the horn trading plan manages to stay on top of things and manages to keep us in front of opportunity. Okay, with that, I'm going to ask for any questions. And you guys who are here from our group today, who are looking at this, you can let me know if there's anything that you want to talk about. And I will just look down and see if we've got any questions here. Okay, so for the around the horn trades, do you automate? Yeah, so those are totally suitable for automation, which is of course the way that that we put these trades together. So what I'm doing with them is this software behind me right? This is Realtic. Realtic's the platform that I've relied on for 23 years at this point. And, I don't change around a lot. I've got a lot of functionality in this that I really like. And what I like most about Realtic is that, the API allows you to go and take the nightly spreadsheet that I send out to all of you guys with the entry, the exits, right, the money management rules, all that stuff built in, and then we can just auto trade that against the platform right from the spreadsheet from Excel. So the API makes it very suitable for that. The practicality of it is, a lot of mornings we're sort of figuring out which part of the plan we want to focus on at this point, and then really what winds up happening is that Julie will take those trades manually and she does the money management on them over the course of the morning. But that's a good question. So no, you don't have to do it that way, right? You don't have to automate it to generate the result. The idea really is that you're the automation, you're the robot, you're sitting there and you're just figuring out every morning, this is exactly what I need to do, this is what I said I was going to do, this is what I'm going to do. And once you get that discipline down, it's going to make this next trade that I'm going to look at here, which I call Baltimore Chop, a whole lot easier for you to deal with. So, Baltimore Chop. This is one of those trades that I put together in around the horn and wanted to use a metaphor. And it's a statistical trade. It's a 2SD gap reversal. It uses the implied, well, it used to use the implied volatility of the front month contract for every single stock on the exchanges. That became very tedious. What we had to do was load that all into spreadsheets, and we had to make sure it was updated every single day. Options data is not available the way stock data is. We found that out early. If the computer was down for a day for some reason and we couldn't get the data, the whole thing was screwed up. So I'm going to show you how you can calculate this much more easily with something that is a proxy for volatility in a second here. First, I'm going to show you why I called it Baltimore Chop. Baltimore Chop was a Baltimore Orioles trick. If you had a guy at home who was batting and he was a bad runner, what he would do was spike the ball down into the ground, pop it over the pitcher's head, and by the time he could field the ball and get it to first base, that runner was already on the base. And I'm going to show you in just about a minute here why it is that Baltimore Chop looks to me an awful lot like what that batter was doing. So first, let's get into that proxy that I was talking about. All of you know what range is. A range of a stock is just today's high minus the low. You see here on this bar that we've got a high price on the day, there's a daily bar, we've got a low price on the day. And if you take that high at, let's say, $50.10, the low at $49.40, and you say, what's the range? High minus low, 70 cents for the day. Everybody understands that. True range, on the other hand, is a little bit different. True range is going to be the greater value of that range that we just looked at, or the absolute value of the high minus the previous close, or the absolute value of the low minus the previous close. And why is that important? Well, because when you're using a statistic to measure something, what you want to make sure of is the thing that you're measuring is actually the thing that you're interested in. And range is not what we're interested in. If we're looking at gaps, we're looking to figure out if the gap today is statistically likely to make a reversion to the mean. And in this case, if we take true range, which is the high of this bar, minus the close of the previous session, then the value that we have includes that gap from the open to the previous close. So if the high was $50.10 and the close the previous day was $49, now our true range is $1.10 for the session. And we've got some assumptions we need to look at here. The first one is, when you're dealing with statistics, you need to know that the phenomenon that you're trying to measure is normally distributed. So is true range normally distributed? Julie and I have done a bunch of work that says it is, and over the years there's certainly a lot of data that says volatility in general is normally distributed. Then we want to know, is true range a proxy for volatility? And in our case, it's not only a proxy, it's a better representation because, as I said, it ferrets out those gaps and uses those as part of the model of what you're looking at, what you're trying to measure. And then finally, is volatility mean reverting? Volatility is definitely mean reverting. We'll look at mean reversion just for those of you who don't know what it is in a second. It's a very easy concept to grasp. But when you have all of that in hand, what it gives you is access to this thing right here. This is the standard normal distribution. In the middle of that distribution is something called mu. And mu is just the arithmetic average of a bunch of numbers that you're looking at. So you've got an average value in the center. If you go out one standard deviation to the ends of those red ranges there, that's going to account for 68% of the variability away from that mean that you expect to see, at least for the immediate future. So 68% of what should move away from the mean has already happened. Go out 2 standard deviations, now you're talking about 95%. You're in the 95% confidence interval of the mean that you've moved as far as you should be moving before you start reverting back toward the mean. And here's what mean reversion is. I'll just give you a very simple diagram here, very easy to figure out what this is. Mean reversion refers to the fact that in the middle of the data we've got a mean. It's our arithmetic average, right, that we just talked about in the bell-shaped curve. And then we've got periods of high volatility in this case, where we're moving away from the mean, and periods of mean reversion, those blue balloons. So the red balloons are the gaps, right, and the blue balloons are moves back toward the mean. We're not looking for a move back to the prior day's close. We're just looking for a move back to the average volatility. So the formula for this is super simple. A standard deviation is just you take each day's true range is X. So we're using 10 days worth, right? 10 true range calculations. You take the average and subtract it, the average of those 10 days. So you add up the 10 days that you're looking at, and then divide it by 10. That's your average, right? You subtract that from each individual observation. Then you're going to square that number to get rid of a negative value. You're going to divide it by n, in this case 10. If you had a larger sample set, you'd use n minus 1, give you some degrees of freedom. And then you take the square root of it to get rid of the square. That gives you 1 standard deviation. So here it is, the sample calculation. You see here we have 10 days worth of true range data. We go and plug that into this formula, and we subtract 1.25. That's the average of those 10 numbers is 1.25. We subtract that from each observation. Then we square that. We divide it by the count, n. And then we take the square root, and that gives us 1 standard deviation. So 1 standard deviation in this case is 49 cents. You would multiply that by 2, that's 98 cents. You would add that to the mean of $1.25, right? $1.25 plus 98, $3.23. That represents the amount that the stock would have to gap in order for you to have an alert telling you that it's time to go and try to fade that back towards that mean. So how often do you have to use this calculation? Never, because you're going to have your spreadsheet do it or your software do it. This is very easy to program, very easy to have put together for you. There are some simple rules to follow when we put this trade together. The first is that we've got that gap. It goes and it qualifies, gives us a number, says it's 2 standard deviations above or below yesterday's daily bar. And then we enter the trade just above the high or below the low of the deepest bar in the gap. And by deepest bar in the gap, I just mean it looks like a pullback. These are the 5-minute bars here. These are idealized. Last bar there on the left in that top range, bar number 1, 2, 3, 4, right? That's the close. Here's your gap. And then we start moving lower. And you see the second bar has a lower high, third bar has a lower high, fourth bar. This one is the lowest or the deepest bar in that pullback. What we're going to do here is look to go long above the high of that bar. And usually what we do is target the open, the close, the high, the low, something significant in that first bar of trading. And why did I call it Baltimore chop? Because to me it looks a whole lot like that batter spiking that pitch right down into the ground, popping it over the pitcher's head, and we are off to the races. So how do you find these? You do this in your software. You can use our scanner. You're going to have access to this when you're in the first hour trading pit. So as I said, you're going to have a couple weeks that you can join us for free. There's no credit card required, no nothing. I prefer that people come in and self-select, right? Decide that they want to work with us, as opposed to us trying to trick them into giving us a credit card and trying to force them into something. There's no forcing anybody into anything here. This is either going to work for you, or it's not going to be something that interests you, but it's important that, like I said, it's a good psychological fit and that it's actually something that you want to do. So what you're looking at here is the scanner. What the scanner does for you is goes through and segregates by S&P 500, S&P 400. Is it a news-driven trade? That's the final column. And then is it earnings? So if it's earnings, it would have an asterisk. In the case of this trading day here that we used in the presentation, which was just a couple days ago, we had SGMS and SGEN. Those were not earnings. Those are news-driven. So when we don't see the asterisk next to them, the first thing that I do is I go and look at the news source. Before I move on and show you the news source, note that they're highlighted in yellow. The reason those highlights are there is when the scanner comes up, as I go through and I parse these for my own use, I'm highlighting for the guys which ones we're going to be trading, because it's not an open outcry room, right? I'm not sort of, popping off opportunities. I'll just say, look, number 1, number 3, take a look at your scanner. Those are the ones that I highlighted. That's because sometimes it's hard for people to understand it when you're calling out symbols, right? It's very easy to, SGNS. Well, did he say S or X? What was that he was talking about? This way, it's just right in front of you, and you can see exactly what we're interested in. Then, you want to pop out and take a look at the news. So in our case, we use the fly on the wall. I've used this for, pretty much the whole Magilla, the whole time that we've been trading. And, what you see here is we have stocks moving higher, and you see Seattle Genetics. It's up 9%. After entering 2 oncology collaborations with Merck. So we know there's a reason. This is almost like an earnings announcement, right? This drives a revenue line that might be significant to the company. Very likely that that's going to shift the market this morning. Also very likely that it's going to be an overreaction. And if it's 2 standard deviations out, we're going to look to fade it. Then the next one, SGMS. This one, investors to acquire 34.9% stake. And again, this is news that's going to drive the stock in the morning. It's not a takeover per se, right? If you see that it's a merger or a total acquisition or something, those tend to not work out very well because they flatline and they don't give you a trigger. But so we've got 2 stocks this morning that we're going to work with, and here you see SGMS. So again, just like the model that I showed you, except this one's on the short side. Now follow the numbers, right? Here's your open. That low of that first bar has that red line underneath it. Now we just start following up. If that second low was violated by the third bar, that would be our entry, and we would target the opening price of the first bar. Now, if it goes up and this third bar, if this becomes the violation, if bar number 4 violates that red line on the way down, then we're going to go and we're going to target either the open or the close of that first bar of trading. So in this case, I would be looking for the close of the first bar of trading. We sort of want ease of movement here. We want to see that a range that we're coming into is a range that we can expect a very definite inflection at. And then, as we move higher, our suspicions are just confirmed that if we get an entry, we're going to look to get short right below here, and we're going to target the close of that first bar of trading. So let's take a look at how this plays out. So you see here, I've got a line, $27.86. That represents the place that I want to put my short sale. Then we go and we take a look and we say, what is it that's going to represent a violation that would make for a decent stop on this? I've got $28.77. So the reasoning for that, the rationale for that is, if you look back here at bar number 3, that's sort of where price broke out and started moving higher in bar number 4. And also, in order to get up through the stop from the entry price, we would have to get through this volume by price over here. The data on the right side of the chart, that is volume by price data. The data on the bottom of the chart, volume by time and buy sell by time. But all these things together put together a picture that tell us if we get up through there, we've undone the momentum to the downside of the 27.86 move, and we're going to look for the doors. We're going to look to head for the hills at that point. And $26.15, the close of that first bar of trading, that gets us into the point at which the price took off, and it also gives us a very good target in terms of, a lot of stuff happened right here in order to drive price higher. Most likely thing I'm thinking is going to happen if we hit that level is that price is going to start moving higher again. And, we don't hit it until very late in the session. That is not the norm for this trade. Usually this trade is over with in the first hour or so. And it's certainly the case that we don't take any of these trades after the first half hour of the day. So how would you set this up so that you could just automate it and walk away from your machine? You see here that in Realtic, the way I set these orders up is I do a bracket order. And what a bracket order does for me is it allows me to set up the trade in its entirety. So we've got a stop limit at 27.86 with a limit price of 27.83. So that says if I hit $27.86, if I move down to that number, I'm going to sell short 27.86, and the worst price that I'm willing to accept is 27.83. The limit price is the worst price we're willing to accept. Then I make sure, right, that I'm routing as efficiently as I can. It's a NASDAQ listed security. I want to route to the NASDAQ. I definitely want this to be a day order. I don't want this order hanging out there if it doesn't trigger. And I want to make sure that I've got my exit order set to day as well. And those exit orders, I'm going to buy 100% of my position for a loss, just in case I didn't get filled for the whole thing, right? So if I put in 100% rather than a quantity, then it'll go and make the adjustment for me and fill me for less. If I only got filled, say, 840 shares, I don't want to get filled 1,000 on the way out and wind up long the stock. So getting me out for a loss, you can see there the potential P&L. Getting me out for a profit, at the profit objective, you can see the P&L. I look at this, I see that things are right side up, and I'm good to go. Place the order, and that trade is ready to just take care of itself. And then you do that for bar 2, bar 3, bar 4, right as it's moving up, you just go and do a change order, and it will automatically just go and keep modifying that order and replacing it, and then you can focus on some of the other trades that we're going to talk about in a second here. Here is Seattle Genetics. A little bit different on this one. This had a first bar that gave us every indication that we were probably going to have a violation of that first bar low. That's something that I call a trapdoor when I see it. In this case, it was not a trapdoor. We had sort of a 1, 2, 3 pullback. But when we have a trapdoor set up, those of you who have taken the opening gap course, you know that we start looking at fib expansions and places that we can expect things to go. So in this case, we would have 2 profit objectives. And knowing that we have a low at that symmetrical triangle there, we have a low that tells us if we get below there, we're going to target the low of bar 1. That's already going to be a pretty decent range. Getting in at 163.95, and that is going to be countered by a 164.86 stop loss. And that stop loss, again, is based on getting over the entry bar high and over this volume node here. So 2 major things have to happen in order for me to stop out. So as soon as it gets me down to the entry line, I'm using the entry bar high and that close of the first bar, open of the first bar, close of the second bar. That's all significant stuff I'm looking at. That tells me if I hit that number, I should probably be getting out. Then we've got a target, 162.69. That's going to be our opening bar low target. But even though I see that there's that inflection there, I also see that I've got an opportunity for a fib expansion down to the 1.50 expansion range, right? So I use the 382, 50, 618 retracements. I use the 138.2, 150, and 161.8 extensions. So in this case, 160.33 would be the extension move that I was looking for on this short sale. And you can set this up a couple ways. You can either do it all in, all out at one or the other, or you can have this Fibonacci expansion target be a secondary target on the trade, which is exactly how we set it up in the room that day. So you see here Seattle Genetics. Again, I'm going to route NASDAQ. I have a stop price 163 spot 95. I've got a stop limit at 3 spot 85, so that means I'm giving it about 10 cents worth of slippage based on what's going on the montage. I'm looking at the level 2 screen. I see that I've got a 10-cent spread. I know I'm probably going to wind up giving up the spread, but I definitely want to be in the stock. And based on the fact that we've got a pretty wide profit objective on it, I'm pretty content to go and give up the 10 cents on the entry. Now in this case, you see I've got a 100% exit for a loss up at 164.85, and I've got a 50% exit for a profit at 62 spot 69, and then I've got the balance going out at 60 spot 33. And this is just a good way to structure this trade. You've got a 2-to-1 reward to risk ratio, and once you get down below that first profit objective and it starts extending, if it doesn't get down to that second profit objective, the worst case scenario is you're just going to take the rest of it off at that 62 spot 69 level, and you at least gave it the opportunity to get down to your logical extension. So that represents sort of the lion's share of how those trades play out. And at this point, we can take some questions and get into what it is that maybe you don't understand about what I just talked about. So let's see if we have any questions here. So this is from our group today. I think from the Money Show group, there was just a question about how do you calculate these things on the fly, and what's the mechanic or the mechanism behind getting this data represented in a way that you can parse through it in the morning. So there's two things. I mean, first off, you saw our scanner, which is not very pricey. That's a $200 a month product, right? It's not a very expensive thing to have on your desktop. Or you can use, if you've got Metastock or you've got TradeStation, or you're good with Excel and you want to tie it to Realtic, there's a bunch of things that you can do to go and have this in front of you for an insignificant cost, especially in light of the amount of potential profit on the trade. So if anybody else has questions about the chop, the psychology of the chop, yes. So who is this going to be a good trade for, right? What's the psychology of getting into this position each and every morning? Well, for one thing, you have to have the courage of your convictions, because what tends to happen with these is they have a very high probability of hitting the entry and then hitting the target. But if they turn around and they stop you out, right, you can't let that become the driving force of whether or not you're going to take the next trade. And that happens quite a bit. So people have this thing called the recency effect that sort of prejudices them against repeating what they just did when it didn't work out, or it biases them in favor of doing what they just did if it did work out. So it can go and take something that's a sound trading idea and take it off the table for you because it didn't work the last time, and I saw this before, right? So I'm going to hold off. And then when you hold off and it dives, dives down through your price and hits the target, then you wind up kicking yourself, right? And there's this whole thing about disappointment and regret and the different psychological impacts that those phenomenon have. And you just really don't want to wind up in that position. You want to get yourself simulating these trades. To this day, Julie and I will simulate the trades that we do. We use Trading Sim. It's a very nice product. You can just go to their website and look for it, tradingsim.com, I think. And it allows you to go through and sort of dry lab this stuff and get to the point that you're comfortable doing it, that you're comfortable seeing it play out, that you sort of have an understanding for how many times can I expect this to work out in my favor, how many times can I expect this to go against me. You can look back. We've got historical data on everything that's scanned up on these dating back 2 years. You can use that data to go through the simulator and then put it together in terms that work for you. Figure out, does this actually suit my personality? Is this something, can I focus my attention on 2 or 3 stocks first thing in the morning, make sure that I have my orders ready to go, or is that something that causes me some kind of psychological discomfort, right? So that's the psychology, I think, that you need to incorporate when you're looking at this particular trade is, can I organize my workflow in a way that this makes sense, especially in light of this next trade that we're going to look at here. Here is the next strategy. This is the volatility band strategy that I've been trading for many years. You guys have heard me talk about this live at the expos. I've demoed this. I traded this in a trading competition that I won. I've showed people how to use this thing so many times that I can't even count. And a lot of times they look at me like it's some kind of voodoo that it works out. But the reality is that what you're doing here is you're just taking intraday data. And in the case of Apple, what we're doing is we're taking a 5-minute chart, and I'm drawing lines. And the lines are just going through and bracketing off where I see significant bands of volatility, because what I'm assuming each one of these levels here represents is program trading numbers. And each one of the program trading levels is something that you can identify because there's a significant number of highs, lows, opens, closes, right? Things that sort of aggregate around that level. And what this tells me is that as the market is coming into these areas, we've got a program on the other side that is making a market right there. And what we're interested here in doing is participating in those levels that the program identifies. And you're going to see on the trading plan that you receive each night that I go through then and I mark these, and each one represents a potential volatility band for the next trading day. So the next thing that I do is I look at this volume by price data out here, and I want to see if that lines up nicely with those volatility bands. And you can see here it almost looks like a very clean little histogram inside of each one of the bands. And what this does is gives me the confidence to say that I think that these programs are, not manipulating price, but are acting on price in a way that's predictable for each one of these levels. So at this point, I've got a plan for the following session that makes sense to me, and I can go through and plan my trades for the next day. And you can see here that during the next trading session, at each one of those levels, right, in this first instance here, price opens above 114.58. The first thing we're looking for on the open is order flow. So when you're trading the order flow, what you're looking for is a move back down to one of those bands that gave you a significant inflection. In this case, 113.79 would give us an entry, and then we would be looking for a move back up to 114.23. 114.23, it dips below the line again, gives us another entry. Now we're looking for 114.58. When it dips in that same bar back down to 114.58, it gives us the opportunity to trade all the way up to 115.22. And then over the course of the session, you see that what we're waiting for is always the inflection trade. Our bias is on the long side. The stock is net positive on the session. Market's positive on the session. So I'm always waiting for these bumps at these lines to happen from above. So it comes down, it touches the line, it gives me the opportunity to go long, and in each instance here, you can trade this the first hour or you can trade this all day. What you see is those bands from yesterday's volatility do a very nice job of constraining what's going to happen today. So the other thing that I do look at is the pre-market, and if you're in the first hour trading pit, you'll hear me making modifications to the band just before the open. And in this case, you can see we added 113.51, 113.76, and 114.86 based on the activity that happened in this red box, which is pre-market trading in Apple, which tends to be very, very liquid. It's as liquid as the cash session in many other stocks, right? It's not unusual that you'll see 3 or 4 million shares go off in the pre-market on Apple. I transfer all this stuff to my trading plan. I've got my volatility bands. I have an eye on what are going to be the floor trader pivots for the following day. And then the way that you just saw them play out is the way that we trade them. Now here are the trades that represent sort of our secondaries for these. And the way that our workflow goes, that Apple trade is a given every day of the week. The Baltimore chop trades are a given every day of the week. If we're slow on one of those, or if we have a second to look at something else, it's going to be one of these trades, which you're also going to have access to during your trial. And these are my just NASDAQ scalper setups. And you can see here in the case of BABA for this day, right, we had an entry 274.45 with a first target 274.80, then 74.80 up to 75.14, and then 75.14 up to 75.60, and so on for all the other stocks on that plan. And then you see that BABA, over the course of the session, gives us opportunities then to enter the trade. I'm going to zoom in here and just show you how this one played out, so that each time that we get the inflection at the line, we're able to capitalize on the bounce from the line that we planned during the session. And this just makes for a very, very nice way to keep these trades, which are essentially discretionary trades, organized in a way that makes it possible to be very, very methodical about what we're doing and get in front of opportunity in a way that provides for some consistent results. So if you go to traderinsight.com/ebook, you can get some more of the materials that accompany today's class. You can get this ebook right here. This is First Hour Trading Super Strategies. It's going to cover in detail the stuff that we talked about today. This gives you a sort of 45-page view of each one of the strategies. It's not an advertisement. There's no advertising in it. It just goes through, talks about all the strategies, shows you how to set up, in addition, the conditional orders that would make these things trade. Conditional orders are a little bit different than bracket orders. They're structured orders that get you in front of the opportunity for profit, but they only trigger when the order actually is qualified to go live. So a lot of times what it'll really do for you is keep you from having your margin impounded. So a bracket order can go live when you push the button, right? The bracket order's out there. The conditional orders are only going to go live once the order is qualified for execution. So, with that said, make sure you capitalize on all this stuff. As I said, you get the ebook, you have those tests that you can take. You can go, you're going to get a trial to the trading room and to all the trading services for the next couple of weeks. As I said, if you'd like to extend that to a month, you can do so as long as you're not a current trial or a recent trial. You can go and extend it out to a month. We have no problem at all extending trials. Like I said, what I want to do is work with people who want to work with us, and I want to work with people who really love this stuff and embrace it the way that we do and our students do. The people you're going to meet in the First Hour Trading Pit, those are all alumni of the Income Trading Bootcamp. They take this very seriously. They trade for a living. Everyone is in there talking about and trading the same things. All the trades are planned the night before, and every one of those trades is only talked about in relation to, okay, we're coming up on the planned entry. You guys all know what the planned entry is. You all have the parameters for everything that you're about to do. So that puts you in a position of hopefully having the courage of your convictions and not feeling like you're in one of these rooms that plays a game of musical chairs, where if you're the last one standing when the music stops, you've got a little bit of trouble on your hands, right? So with that, let's move on to some questions and see if there's anything that isn't clear after this 2-hour presentation today. All right, so no questions from our guys today, but yesterday we had an interesting one that I just wanted to touch on, and that was, can you use things like self-hypnosis or hypnosis to overcome some of the psychological roadblocks that go along with trading? And I think, it's great that somebody puts a question like that out there, because the psychology is difficult, and your psychology is something that's very difficult to work on because it's something you've done all your life, right? And most of us in this business are not teenagers. We sort of have the habits that we have, and we've had them for a long time. And I will tell you that psychology will tell us that things like hypnosis are one of the only ways to break habits like cigarette smoking. Cigarette smoking has a higher recidivism rate than heroin, and people who stop smoking using hypnosis have very, very high success rates, very outsized success rates compared to things like nicotine patches and all that kind of stuff. So can you go through and work on yourself and meditate and do sort of some of the self-hypnosis stuff where you're focusing on something very intently and counting and telling yourself sort of positive thoughts and ideas about where you're going to be? My dad used to say, just see yourself successful and then look back and figure out how you did it. And that was the best way to get somewhere. And that's almost the way to hypnotize yourself, right? Where you sit down, you just start focusing intently. Okay, well, this is what I'm going to need to do to get where I want to be. We've got Paul, who's very successful, trades all sorts of stuff and makes really good returns. And he meditates. And he's very good about just getting inside himself and understanding where he is, where his head's at. And, it's been a great resource for him. So the answer to that question was a definitive yes. And I think it was a good question, so I wanted to repeat it here today. And now I just take one quick look at something that we've got for you. This allows you to join us each morning. There's no credit card required. As I said, you can have 30-day access to the First Hour Trading Pit, the Gap Scanner, the Fastball XRV Seminar and Service, Daily Income Trader, and you just have to text trial to that number. If you haven't texted regarding anything else here today, if you texted regarding one of the other things, then you've already got this. we're going to do it for 2 weeks at first, so it's going to give you an automatic 14 days, and then, like I said, all you have to do, pick up the phone and call us. The help number is down below there, 310-584-6590. That's Victor. There's only 3 of us at Trader Insight, right? We're a small business. It's Julie and me, and we've got Victor, who just manages relationships with our clients for us. And, I think you're going to like what you see, and I think at the very least, you're going to see a different way of approaching the markets. You're going to see something other than your standard sort of options trading stuff. A lot of our guys do options on these things. A lot of our guys are actually also trading futures, also trading other instruments, but you're going to see a different approach to the markets, and I'm certain it's one that you're going to be able to appreciate. I'd like to thank you for taking the time to join us today. I'm sorry that the original recording of this had some audio issues. I hope this takes care of that and cleans it up for you. The folks at the Money Show represent a very important relationship to us. We have spoken at every show since 1999. It's sort of how we get out there and meet people and get out of this office here. I'd like to thank you for joining us in our home today. And if you have any questions, you can email me, adrian@traderinsight.com. Adrian, Adrian, @traderinsight.com, or you can call that number on the screen and ask Victor to schedule a call. I'm always happy to talk to you folks. And again, thanks for joining us today.